Howdy, Jacob here. Today we're looking at Sirius XM Holdings, the media industry, 23 billion enterprise value, 14 billion market cap, so quite a bit of net debt here. Company's been around for quite some time, 2014, that's just 2013 is just not true. Basically, in your car or wherever they operate as Pandora as well. Okay, I guess I didn't realize that. So, yeah, they basically anytime you use a rental car, I'm sure you have that little sticker on the side that says Sirius XM capability. That was one of the first listening platforms, if not the first. I'm not entirely sure, but definitely one of the first for sure. Growth is actually fairly impressive. I wonder if this is acquisitions or not, but 4.1 billion to 8.9 billion in revenue, so over doubling. Um, Gross profit, operating margin, relatively flat. Operating margin actually down a little bit. Same with gross margin, but still very solid margins. Business, 20%, very impressive. Dividend per share has been paying a dividend the last 8 years or so, and it's been going up quite a bit each year. Looks like a pretty reasonable amount compared to their earnings per share. Return on invested capital and return on assets looks very solid, double digits, well above their weighted average cost of capital. So they're creating business, which is good. Return on equity is negative. Again, we're looking at a good amount of debt here. In fact, negative shareholder equity on the balance sheet just means more total liabilities than total assets. So we see $8.7 billion in long-term debt with just 216 million cash on hand. It's a huge amount of debt for the liquidity that they have, but let's look at their free cash flow and see what it is in relation to that. So free cash flow, maybe let's be generous, $1.5 billion is over 5 times. You're looking at about 6 times their 5-year average free cash flow in long-term debt. So it's definitely more than what I would like, but it's not absolutely concerning. The only thing is they do pay a dividend that, dividends are a bit more sticky than some of their other forms of capital allocation, and they do pay maybe 25% of 25% capital allocated to dividends. I mean, it's not a whole lot, but that is, you're just left with 80% to reinvest, buy back shares, pay down this debt. Because again, they have a good amount of debt figure, a good enough debt figure where I do want them to allocate a good amount of their free cash flow to debt reduction. What we see historically is a whole lot of share repurchases. It looks like capital allocation changed a little bit from 2021 to 2022, but and I mean, let's see whether that's when their share was cheaper. So all time, yeah, not entirely obvious, but anyways, capital allocated most to share repurchases, a little to dividends, and then a little bit to acquisitions here. We see 2017 and 2020 were pretty large net acquisitions. So interesting enough, 35% revenue growth there for not like a huge net acquisition. So that's kind of interesting. But yeah, I think ready to make some assumptions here on the revenue growth side. And maybe 5% P, price to free cash flow. I mean, again, they have a huge amount of net debt here, so you got to take that into consideration. So maybe a 13 P for margins. They're all pretty solid. Free cash flow is a lot higher, which is great. They'll do 14 and 18, a pretty big range. With 1% share change would be about 140. Offset stock-based compensation is already $180 million. So let's say share change relatively flat. The dividend, I mean, they've been increasing that quite a bit recently. Maybe we'll increase it with the revenue growth. So with these assumptions, we're saying that about 20%, 20 to 25% of capital allocation going towards their dividend. We're saying about 10, 15% going towards share repurchases, and then 50%, I mean, a good amount to debt reduction, and then maybe 20 to 30% to make acquisitions to reinvest back in yourselves to get these types of returns. So, I mean, really, it doesn't look too far off here. I think I would just want to dig into the debt a little bit more, but this is a pretty interesting price, I gotta say, and one that I might do more research on soon. But again, it's going to be on you to be comfortable with your own analysis. Make sure you're comfortable with the debt. See when it's due. Whether you think this company can actually make 5% a year, make these types of margins. So probably not too much longer until I do a video on this on a deeper dive level. So hopefully you enjoyed the video and have a great day. Thank you.